Yeah, the rupee all-time high, and I guess that's the added pressure that one is seeing on the FI figures as well, right?
That's true. Nearly 2% since the beginning of this quarter for rupee, and if you look at it, it comes as a tailwind for the Indian IT, given the fact that on a quarter-to-quarter basis, on a dollar-to-dollar revenue, there may not be much growth, but in rupee terms, there will be at least impact on the PBT level. So for every, I think, analyst was telling us, for every 1 rupee depreciation, the PBT gets impacted by nearly 3%, which is there. And if you see, dollar is depreciating against other currencies, but appreciating against the rupee. So, the impact could be roughly around 1% or 1.5%, which on the PBT level for many of the IT companies.
Not just that, commodities.
Yeah.
Commodities get expensive, of course, and therefore there can be support in terms of commodity prices for domestic companies, and that will also support earnings and margins for them. So, a couple of angles to look at this. Of course, exports get better, but imports get dearer, and that's
I think that's the cost we are willing to pay, because if I go by the statement of the chief economic advisor, he's saying that he's not going to lose sleep on the rupee depreciating. So it seems that it's the policy of the government to counter the impact of tariffs through a rupee depreciation,
something make exports
viable. Yeah. And this is a similar strategy which was followed by the Chinese central bank as well, in allowing the yuan to depreciate, so that when the tariff was much higher, the yuan was depreciating to cushion the economy there. So I think they're comfortable with this thing. The question is the 90 rupee mark for us that becomes the headline for us in that sense. But even now at this point, there's certain sectors which are most impacted by the tariff, especially labor-intensive sectors like textiles and others, which will be which still don't have those orders there unless we are able to diversify to other markets.
And headline it sure is. I mean, it's getting everyone to talk, including Uday Kotak.
Yes, absolutely. In fact, he mentioned that if we can pull up that tweet.
I have that tweet. So he's saying the proximate reason, it's a warning for India Inc. Firstly, he says. And he says, rupee at 90, the proximate reason, foreign selling for Indian stocks by both FPIs as well as PEs under FDI. He's saying Indian investors are buying. Time will tell who is smarter. For now, foreign seems smarter, he says. He says 1 year Nifty dollar return is 0 now, but this is a long game. Time for Indian businesses to shake out of the comfort zone. So really putting it out there as to only time will tell who's actually smarter.
Just to give a number there, Indian companies used to go overseas raising for dollar bonds. That has come down a lot. Means we have done only $9 billion in this year. Companies have now gone into the domestic market to raise funds, and we raised roughly around $140 billion. Companies raised $140 billion in corporate bonds this year from our market, only because rupee was depreciating.
Foreign companies are coming here and listing and making those gains which they can't globally.
That's the equity side of it. Yeah, they're trying to take away the profits which is part there. But for a economy where we need more capital to do expenditure, whether it's capex or any other expenditure, the first port of call used to be the London or the Singapore or the New York to get that bonds done. Now nothing is happening. I think now foreign bankers are now coming in India, because the Indian market last year did a $140 billion bond sale, which happened.
Yeah, absolutely. And on the equity side of things, only time will tell whether FIs are emerge as winners or whether it's going to be the DIIs. And only in the long term will we know that. So we'll have to wait and watch out for that.